Hey everyone, welcome back to the channel. Today is December 8th, 2025, and this is your weekly 5-point market rundown. The biggest stories investors will be watching over the next 5 trading days. If you follow stocks, crypto, energy, or the Federal Reserve, this is a huge week. I'm going to break it all down with clarity, accurate sourcing, and the context you actually need. No noise, just the signal. Let's jump right in. But first, like and subscribe for more daily updates and insight. Starting with the Federal Reserve and its final meeting of 2025, scheduled for December 9th and 10th. According to Reuters, Bank of America expects the Fed to cut interest rates by 25 basis points at the December meeting, followed by 2 additional cuts in 2026. That's shaping market expectations heading into this week. Per FOMC policy history, the current federal funds rate is between 3.75% and 4.00% after a series of cuts earlier this year. The critical question isn't just whether the Fed lowers rates, it's how they frame future policy. Reuters recently noted internal divisions among FOMC members about the pace of easing, which raises the stakes for what Chair Powell says at the press conference. Because of that, the real market-moving moment this week may well be Powell's comments and whether the summary of economic projections shows additional cuts for 2026. That's why markets will react sharply, especially in interest rate-sensitive sectors, tech, real estate, home builders, and fixed-income instruments. Expect volatility in 2-year and 10-year Treasury yields, as well as large-cap growth stocks, immediately following the announcement. Now shifting to the macroeconomic backdrop, inflation and economic momentum remain key variables. According to AP News, the Fed's preferred inflation gauge has recently shown modest monthly increases, stable but still elevated. That means inflation hasn't collapsed yet, but it's not spiraling upward either. On top of that, consumer spending, wage growth, and general household activity appear to be cooling, according to the same reporting. The next official CPI release, covering November, is scheduled for December 18th, per the Bureau of Labor Statistics. Since that comes after the Fed meeting, market participants will be acting on expectations rather than fresh inflation data this week. That dynamic lends extra importance to any smaller economic data points, jobs, sentiment, manufacturing, etc., that hit between now and Wednesday. So what does all that mean? If recent data continues to look soft and markets believe inflation is under reasonable control, the Fed may get more comfortable easing. But if sentiment shifts, or if inflation expectations creep up, markets could grow more cautious. Next up, energy markets, always a sleeper catalyst. Recent coverage from Trading News shows WTI crude at roughly $58 per barrel and Brent around $62. That reflects ongoing pressure from elevated global inventories and persistent U.S. production strength. On the supply side, this implies that oil markets are still oversupplied for now. Looking ahead, the U.S. Energy Information Administration, EIA, projects that oil inventories globally will continue building into 2026, with Brent averaging roughly $54 to $55 per barrel. If that forecast holds, it may help moderate inflation. Good news for consumers and rate-sensitive sectors. But it also pressures energy sector equities and could dent corporate earnings in oil and gas. However, the energy space remains a risk. A supply disruption, geopolitics, natural disasters, or underinvestment could quickly invert the trend. That kind of volatility tends to ripple across everything: inflation expectations, bond yields, and equity sectors. Now, turning to tech and AI, the heart of growth investing, the structural investment in AI infrastructure and data centers remains strong. Although this week doesn't feature major earnings releases, analysts and investors are watching closely for any guidance revisions or commentary from large technology companies on data center expansion, cloud spending, and infrastructure investment. According to energy demand analysis included in the EIA's commentary on data centers, global electricity consumption tied to computing and AI infrastructure continues to rise into 2026, supporting the narrative that tech capital spending won't simply vanish because rates are under pressure. Companies in cloud, semiconductors, and enterprise software are still pouring money into data center expansion and compute capacity. But there's a catch. Tech valuations remain highly sensitive to interest rates. As long as the Fed's communication suggests a favorable rate path, growth stocks, especially in tech, could rally. If the messaging turns cautious, we may see consolidation or a pullback. This is where the crowd's expectations, outside of traditional fundamentals, come into play. Right now, Polymarket, the prediction market platform, is showing sentiment around key financial events. There is an active market on will the Fed decrease interest rates by 25 BPS after the December 2025 meeting, which reflects collective expectations for a cut. Source: Polymarket's Fed decision in December 2025 market. There are also Polymarket markets tied to crypto and asset flows. For example, one that resolves based on whether total Bitcoin ETF flows on December 5th are positive or negative. Source: Polymarket's Bitcoin ETF flows on December 5th market. These markets provide short-term sentiment insights and can become leading indicators for risk-on or risk-off momentum when inflows or outflows shift. Pulling back to the broader picture, all of these forces, central bank policy, inflation expectations, energy prices, tech capital spending, and real-time sentiment signals, interact to shape market tone. If the Fed cuts rates and communicates confidence, and if energy prices remain subdued, we could see a strong risk-on environment with rallies in growth stocks and lower Treasury yields. If the Fed signals caution, or if inflation expectations rise unexpectedly, markets may hesitate or rotate toward more defensive positions. As we wrap up, here are the key points for this week. The Federal Reserve meeting is the central driver for all market activity right now. Inflation is stable but still above target. Oil markets remain soft, according to the EIA's 2026 forecast. Tech and AI investment remains structurally strong but sensitive to rate expectations. And Polymarket's live odds provide a useful real-time indicator of how market participants collectively view upcoming catalysts. That's your complete 30-minute market outlook for the week of December 8th, 2025. I'll continue monitoring incoming data, the Fed's communications, and market reactions. Thanks for tuning in, and I'll be back soon with updates as the week unfolds.